The United College Distinguished Visiting Scholar Scheme is made possible by the generous support of the College Endowment Fund. Under this scheme, United College is able to invite internationally renowned scholars to Hong Kong and to give public lectures and to meet staff and students of the college and the university. The college has much privilege to have invited Professor Stephen Figlewski from New York University as our distinguished visiting scholar this year. Without further ado, I would like to turn the floor to the moderator of today's lecture, Professor Jay Chow. Professor Chow is an associate professor in the Department of Finance in our university. May I now invite Professor Chow to introduce Professor Stephen Figlewski and the topic for today.
Professor Jimmy Yu, Professor Stephen Figlewski, colleagues, students, ladies and gentlemen, good afternoon. It's my great honor to introduce Professor Figlewski, the United College Distinguished Visiting Scholar, for his public lecture today. Professor Figlewski is a professor of finance at New York University Stern School of Business. He obtained his bachelor degree in economics from Princeton in 1969 and a PhD in economics from MIT in 1976. Professor Figlewski has very big academic impact. He is an expert in derivatives, market microstructure, asset pricing, and risk management. He has published extensively in academic journals, especially in the area of financial futures and options. He published over 100 papers, and a majority of his publications appear in top-tier journals, such as Journal of Finance, Journal of Financial Economics, and Review of Financial Studies. Professor Figlewski is the founding editor of Journal of Derivatives, and he served as editor for 25 years until 2018. The journal publishes articles in the broad area of derivatives, financial engineering, risk management, and related fields. In addition to his academic achievement, Professor Figlewski has also worked at Wall Street doing research on equity derivatives and credit securities. He has worked on the multi-assets quantitative research at Citigroup from 2004 to 2005 and served as vice president for equity derivatives products in First Boston Corporation from 1987 to 1988. He was once a member of New York Futures Exchange and a competitive options trader at the New York Stock Exchange. In 2011, he was even targeted by the Securities and Exchange Commission of US for their chief economist position. The lecture today by Professor Figlewski is Volatility and Stock Options and Volatility Derivatives. It's related to disciplines of mathematics, statistics, financial engineering, quantitative finance, and other related fields. So let's welcome Professor Figlewski.
Thank you very much for that lovely introduction. And thank you all for coming. It's an enormous honor. I feel greatly honored to be the distinguished visiting scholar at the United College here. And I'm going to try to tell you something about the area that I've been working on for my entire career. In fact, I started getting interested in derivatives in the summer before I went to university. I'm originally from Chicago, and in those days, Chicago was the center of futures trading. The two biggest futures markets in the world were in Chicago, and I got a job on the floor of the exchange carrying orders into the the traders that were in the trading pits at that point. By the end of the summer, my friends and I were trading wheat futures. And throughout all of my undergraduate time, I was interested in futures markets. I wrote a thesis as an undergraduate on speculation in frozen pork belly futures. Now, a funny thing about that is that you people all know what pork belly is. The people that I've talked to in those days, no one had any idea what a pork belly was. So it turned out in those days that was the most exciting, the most speculative trading futures market in the world. All right? So I got interested, I remained interested, and throughout my entire career I've been doing derivatives. It may show a little lack of imagination. I couldn't think of anything else to do, but it's been a very good area for me. One of the things that made it very good was that the option pricing model, which was the Black-Scholes option pricing model, this was a major development in academic and real-world finance, and it happened in the 1970s when I was in graduate school, and the people that developed it were people that I was taking courses from and seeing in the halls. So that was a very exciting time to be involved in this, and this is an area that has grown enormously over the last 40 years, the times that I've been involved in this. There's a problem, which is that this is it's quite a mathematically and economically challenging area. And so I'm a little bit, more than a little bit concerned that I don't want to spend a lot of time talking to you about stuff that you just have never heard of and don't get it. I would like to end up after 45 minutes or an hour with you that you've actually learned something. And what I've prepared is a bunch of slides. I hope that this is going to be not too much. And so I'm going to start by doing something that I almost always start with, which is I want to get some feedback from you, right? And the kind of feedback I want is that from time to time I might ask a question like, how about this one? Do you know what a call option is? All right? Now, I'm not asking for people to jump up and down and raise their hands. What I'm looking for is just some kind of something like that, or maybe, This is really going to help me try and give you a presentation that you'll understand, I hope. All right, so here's a test. We're going to start with this. I want you guys to say, you see this thing here? This isn't going very well. This isn't going very well. Everybody's neck is frozen. Let's try this again. It's either or Okay, everybody see this thing? Yeah, you guys in the back, you're not doing it yet. Come on. All right. Well, I'll give you the credit here. Yeah, okay, good. That means I'm going to take it off because it's just too hot for me to talk. And if I'm going to walk around and wave my arms, I have to have freedom of movement. All right, let's get started. Let me ask the question that I really wanted to ask is, do you know what a call option is? No, basically a few. Good, well, I've sort of anticipated that, so I'm going to start by telling you what a call option is. All right. A call option, it's a kind of a security that gives you the right to buy something else. And the kind of call options that I'm going to be talking about give you the right to buy stock. Right? So a call option gives the option holder the right to buy the underlying stock on or before some date that the contract expires. That's the expiration date. The price that you would buy at is set today, and that's called the exercise price or the strike price. So if you buy an option, if you own an option, you have the right to buy the underlying stock by paying the exercise price. The person on the other side of that contract, this is a contract between you and somebody else. So if you have the right to buy the stock if you want to, and you have the right not to buy the stock if you don't want to, then the person on the other side has got to do what you want to do. If you want to buy the stock from them, that's because the stock is selling in the market for a higher price than you're going to pay when you exercise. If the stock, so I'm going to give you some numbers in a second, but if the stock in the market is selling lower than the price you'd pay if you exercise the option, you don't do it. You don't exercise the option. And in that case, the option is worthless. The other side of your trade, if you want to exercise the option, they have to sell you the stock. If you don't want to exercise the option, they don't sell the stock. So that person is called a writer. Now, options exchanges will typically have a lot of different option contracts trading for a specific maturity. The one I'm going to talk about in a minute is options on Apple computer stock. I got some prices from the end of August, and the contracts that I'm going to show you briefly are going to expire actually this coming Friday, October 18th. All right. But there will be hundreds, maybe, of different options on the same stock. Apple will have options with different exercise prices, prices you could buy at, and also different dates. So Apple is a very, very actively traded option stock, and it has hundreds of options with different characteristics, all trading based on the same underlying Apple computer stock. All right? So here, on August 20th, the market price to buy a share of Apple stock was $210. This is US dollars. Okay? I wanted to make examples using Hong Kong prices that you might feel more familiar with, but it turns out that the kind of contracts I'm going to talk about don't trade so actively in Hong Kong, so I'm going to have to stick with American data. So the stock, you could buy the stock for $210, or you could buy a call option that lets you buy the stock on or before October 18th. So these are the prices. These are the prices for ones that have different exercise prices. So if you commit today that you could buy the stock for $220, it's $10 higher than it's trading right now, that option is worth $8.40. This one here, right now the stock is selling for $210. If you buy the option instead, you pay $12.50. Kind of keep that price in mind. For an option that lets you buy at the price today, that option is called, it's at the money. And when you think about it, that's the one where you have the biggest optionality, the value of being able to make a choice later, whether you want to actually buy it or not, that has the most value at the money. In other words, the stock right now is selling at $210 a share. It might go up, it might go down, sort of a half and half probability. Well, to have the right to buy it at today's price 2 months later, if you want to, well, that would have cost $12.50. If the stock of Apple stock right at the time these prices came from was $210, if it goes up from that, then the right to buy it at $210 obviously gets more valuable. Apple right now is trading about $236. So if you had bought that option for $12.50 this Friday, you could buy the stock for $210 by exercising the option, immediately sell it for $235 and basically double your money. On the other hand, if the stock had gone down, you wouldn't have done anything, and the most you could lose is $12.50. And so this gives you an idea of what an option type of payoff is like. If the price goes against you, there's a limit to how much you can lose. It's the cost of the option. If the price goes in your favor, well, you have a highly leveraged position, which means that you get a lot of profit per dollar invested if things end up in the right direction for you. All right? The other kind of option is a put option. A put option lets you sell the stock. So suppose in August I owned Apple stock and I'm worried that it's going to go down. Well, I could buy a put option that would let me sell it at $200 no matter how far it went down, and the cost of that kind of insurance is $7.70. I don't think that the price is going to go down, but I want some insurance in case I'm wrong. And that insurance costs me $7.70. These days, in the United States and in a lot of other countries, you can buy and sell call options on thousands of individual stocks. You can buy options or sell options on portfolios of stocks. These are exchange-traded funds, and I'm going to have a lot to say about those in a little while. You can buy options on specific sectors of the market. So you want to buy the oil industry, or the tech industry, or business computing stocks, or any of many other sectors of the market. Or, and these are the most popular of all, you can buy options on the whole stock market. The market goes up, you kind of multiply your profit. If the market goes down, there's a limit to how much you can lose no matter how far it goes down, because the worst that can happen is the option you bought ends up being worthless at the end. Okay, so that's a call option. Those are options. The second basic idea that I want to talk about is volatility. And volatility is, if you get into option theory, option pricing, option trading, you'll see that the one thing that really makes everything move is volatility. Volatility is we have models that tell us what an option should be worth as a function of certain parameters, and the parameter that's the most important is volatility. Now, volatility is a word that everybody uses all the time, and especially when we start talking about the stock market, sometimes it will seem that the market is really volatile. Well, what does that mean? Sometimes the market is calm. That means plainly it's not volatile. All right. Sometimes you'll hear somebody say, the market is volatile. It's going up and down a lot every day. Okay, that's one way of thinking about volatility. Here's another thing that people might say. The stock market is going down. The stock prices have gone down a lot and very fast in the last day, or the last week, or the last month. But the important thing here is that the prices are going down. If the price goes down 10%, we say it's a correction. That kind of means like, well, the high price it was at before is too high, so now it has to have a correction and go down a little bit. But if it corrects too far and it goes down 20%, now we're in a bear market, and that's really bad. All right. Another thing you might hear, and this kind of happens not infrequently, when the market goes down, it tends to go down really fast. When it goes up, it tends to go up more slowly. They say that stock prices, they go up by the stairs, but they come down by the elevator. And then I'm going to show you some pictures in a second where you can see that this is kind of what things look like. So some days it will happen. The market seemed to fall off a cliff this afternoon. Suddenly everybody was selling, nobody would buy. Prices went down a lot. Right. And when this happens, and I come home, my wife will say, did you see what happened in the stock market? Are we poor? And the answer is, people get really excited when the market moves fast, even if in terms of the total value, it hasn't changed by that much. 3.5% doesn't have much of a change in value, even though it may happen really fast. Right. How about this one? the market has been zooming upwards recently. It went up 5% in the last week. Is that volatility? All right, well, somehow we might think it's not really, that's not bad, that's good. But in terms of the statistics, in terms of the probability, in terms of the likelihood of that happening, having the market shoot up 5% in a week is just as unlikely and just as volatile in an important way as having it fall by 5% in a week. So there's kind of different ways that ordinary people talk about volatility. Volatility to an options person, though, is a lot more specialized. Volatility to an options person is how much the price is jiggling from time to time. And so that's not particularly a directional thing. It has to do with how big the daily movements are. A typical kind of number is the stock market goes up or down maybe like 1% a day on average. Well, up or down 1% a day corresponds to volatility of about 16% a year. If the market started going up or down 2% a day, well, that would correspond to 30%, 32% annual volatility. That would be much more volatile. All right, so what we're talking about is sort of how far it might move in either direction over a short period of time. And this is what we need to put into an option pricing model to get a theoretical value for an option. But an option professional has another idea about volatility. Volatility isn't just what the market is doing. We can, once we have a pricing model that has the things that determine an option's value in the model, one of those important parameters is volatility. Well, what happens is if you try and figure out what the volatility is actually going to be, it's hard to predict. But what we can see directly in the market is the price of options. So we can see whatever volatility is going to be, we can see what number the market somehow has put into the formula, and that's the implied volatility. For options professionals, implied volatility is really important. It's sort of a way of saying, relative to the stock, how are they pricing options? And that's determined by the implied volatility. And so I'm going to be looking at both of these things. So okay, so time to look at a picture. What you're looking at here is what the Standard & Poor's 500 index, which is, we generally take that in research as being a good proxy for the whole stock market. And this is what it's done over the last 6 years. And you can look at it, you can see, well, in the beginning, it's going up. There's some periods where things don't seem to be going very far, but there's periodically sharp drop-offs, like I say, the market going down by the elevator. Prices go up a little bit. They get more, pretty calm here, and also one big bad day. But we then enter into a period where the market is going up and up and up and up and up and up and up. It never seems to go down. And you get to the end, finally, it seems like there's no jiggle during the day. Nothing is happening. It's just going straight up. Till it gets to the top here. And then now we enter into a period of considerable volatility, punctuated by a real crash here. We're going to look at this crash in a little bit more detail in a second, which is immediately reversed by the market zooming back upwards. All right? So what's volatility? Volatility is the standard deviation of these daily price changes. For an options guy, it's the standard deviation of these daily price changes. And so what I've got here is the purple is on each day, I'm going to look back a month. I'm going to look back 30 days, look at the returns, the daily returns that we had in the stock market on those days, get the standard deviation, annualize it, and that's the volatility. That's the historical volatility, the volatility of historical data. The scale is over here is on the right side. And those periods I was just showing you, well, in the beginning, there are periods where volatility is fairly low in the neighborhood of 10 to 15%. But there's When there's a sharp drop in the price, the volatility goes up. When there's a sharp drop in the price, the volatility goes up. And that date, the date with the big price drop, stays in your 30 days worth of past data until it's 31 days. And so we get things like this, where this one big drop in one day caused the volatility, 30-day volatility, to go zooming upwards, and it stayed there for a while until that date disappeared from our data sample and things go back down again. When we look at this period here, the market is going up way fast, much faster than you would think. In some sense, this is volatility, but it doesn't count as volatility because look how smoothly it's moving. And when we look down here, we see this time period, to me, was astonishing. This was a period where it just seemed like there was no volatility in the market at all. The average volatility of this index is something like 20% a year. Over the last 25 years, it's averaged something around 20% a year. Here it's under 10. And I'll just share with something, a confusion that I had during that time period. I was at that point the editor of the Journal of Derivatives, and every quarter I should write, I would write a couple of paragraphs about the current situation. And during that time period, I kept saying, I can't believe this. Look at all the stuff that we don't understand. There's people, there's the U.S. government is being shut down periodically by political arguments between the Democrats and the Republicans. There's threats that that the U.S. was going to default on its debt. All kinds of things like this didn't seem to affect the stock market. Why not? Well, that was the big puzzle. Couldn't figure out why it didn't. How could volatility be so low during this time period when we were so uncertain about what was actually going to happen? Anyway, that period went away, and we get to a time when volatility spikes upward again. In this period, this was the end of last year. And I'll give you another look at that, that time period in a bit. A little closer look at that time period. Last Christmas Eve was a catastrophe in the stock market. Okay, so now how does volatility, how does this kind of jiggling in the price of the market, the level of the market, how does this get into the value of an option on that stock? Well, in 1973, Black and Scholes, Fisher Black and Myron Scholes, figured out a formula. And the formula is really, it's a very clever thing, and I'm going to show you, I think, I'm going to show you the underlying math a little bit and try and talk you through it, but not very much. But what their model says, if we know the stock price, Apple is at 210. We know the exercise price. I'm going to price an option that has a strike of 210. Time to maturity, 2 months. All right. What's the interest rate? This is relevant because if I buy the stock today, I have to pay $210 a share right now. If I buy the stock right now is the end of August. If I buy the option, I don't have to pay for the stock until October. So I've got 2 months to use about $200. And so the interest rate during this time period is relevant in how much that option is worth. So all those things I can see. I know the stock price, the exercise price, the maturity, and the interest rate. And the last variable out of only 5 is the volatility. Now, volatility, I don't know. But Black and Scholes have a model saying, if you do know the volatility, we have a formula that will tell you what the option is worth. Okay, so here's the big adventure, right? This is the adventure of can I explain Let me first ask, has anybody in this room seen, and not you professors, you don't count, but anybody in the room who is not a finance professor seen this equation before? I see nobody raising their hands, nobody saying, doing like that. This isn't a surprise, right? But this is the heart of option pricing. All right, so let's see what it says. This equation tells you how stock returns develop. So this piece right here is the change in the stock price as a percentage of the stock price. So this is a percentage return on the stock. This piece, and it comes from two parts. This piece says on average stocks are going to be going up at some reasonable rate a year. Nobody would buy stock if they didn't think they're going to make more money in the stock market than you can make by putting money in the bank. So this is where that annual expected return. So if we figure the stock market is going to go up like on average 6% a year, so that's that part. This part is the risk part, the volatility part. And the key thing in it is this DZ term, which represents random, independent little shocks. And I'm thinking, how can I get this idea across to people who've never thought about this before? So I thought, imagine a monkey. You have a monkey who's flipping a coin. All right? If it comes up heads, the stock price goes up a penny. If it comes up tails, the stock price goes down a penny. All right? Then every second, the monkey is going to flip. So every price change is independent of the ones before. All right? What happens after, let's say, a minute? Well, he's flipped it 60 times. All right? Could happen, you get 60 heads. The stock price goes up $60. 60 cents, excuse me, 60 cents. All right? Can't go any more than that. Suppose it comes out tails 60 times in a row. Well, it goes down 60 cents. But it can't go any further than that. So there's a range of what's possible, which is determined by how much you make or lose each time the coin is flipped. Okay? So the monkey does it 60 times in a minute. You could have plus 60 cents, you could have minus 60 cents, but if you actually do this, get your monkey to start flipping, right? And you see how many heads and tails you come out with. And what's going to happen is you're going to get about 8. Right? If you first, the average on this at the end of 60 flips is, well, you got half the time it's going to be plus 1, half the time it's going to be minus 1 on basically. So you don't expect to have the best estimate of how you have at the end is 0, but you could have 60, you could have minus 60. More likely, you're going to have something that looks a whole lot like a normal distribution bell-shaped curve, where the standard deviation, the width of the thing, is about 8. All right? Okay, I'm going to change my monkey. Every time he flips, you get 1/8 of $1 if it's a head, and lose 1/8 of $1 if it's tails. Well, after 60 flips, you're going to have a thing that has a mean of 0 and a standard deviation of about 1. All right? Okay, now we make our monkey flip faster and faster and faster, eventually get down to 0. That's what the DZ term is. The DZ term is, over the very short interval, what's going to happen to the stock price. But when we accumulate it over time, you're going to end up with something that has a normal distribution with a standard deviation of 1 and a mean of 0. And that's what's driving the risk that goes into an option pricing model. All right? So this DZ term has standard deviation of 1 per unit time. And this sigma term says, well, I got a really volatile stock, so sigma is really big. DZ is giving me 1s, and the sigma gives me potentially higher volatility. All right? Okay. Now, so I've got a pricing model, and I don't know. I'm thinking about whether I should go the extra 2 minutes and tell you how the option pricing theory comes, how the option pricing formula comes from. And I have an enthusiastic guy in the front row who says, yeah, okay, so he's dominating everything. How can I get an option pricing model out of what I just showed you with the monkey? Well, I got another monkey. And the second monkey owns 10 options. 10 of these October 210 strike Apple options, right? Now, if the stock price goes up from 210 by a little bit, the right to buy it at 210 also goes up in value. If the stock price goes up $1, the right to buy it goes up by not a whole dollar, maybe like a half a dollar. Right? If the stock price goes down, it goes down by about a half a dollar. And if we make this really short, so it's only moving by a penny up or a penny down, so every time that the first monkey flips a coin, the price moves a little bit. The second monkey owns these 10 call options, but he doesn't want to be exposed to the risk. If the price goes up by $1, his 10 call options are going to go up in value by about $5. If the stock price goes down by $1, his 10 call options are going to go down by about $5. So if he buys 10 call options and he sells short 5 shares of stock, if the stock price goes up, he makes $5 on the options and he loses $5 on the stock. No change. If the price goes down, he loses money on the options and he makes the money back on the short position in the stock, and again, no change. So that monkey is hedged. Except now that the price has moved, now the proportion of of stock to options that will keep him hedged has changed a little bit. So he's got to revise. But this is a very fast monkey, and he can do this every time the first monkey moves. Flip the coin, rebalance the option position, and it's going to stay with no risk. Right? So there's a couple of things that are really important here. One is that the first monkey who's determining how the price moves, right? What can the price do? Over a short period of time, it could only go a little ways. It can't make a big jump. I first said it can't go more than 60 cents in a minute. It can't go up $60 in a minute. It's impossible. Right? So that's one thing. And the other thing is that the second monkey who is hedging his option position, he can set it up so that every time the first monkey flips, his position has been hedged so it doesn't have any risk. Well, if it doesn't have any risk, it shouldn't earn any more or less than you could get by putting the same amount of money in the bank and earning interest with no risk. It's a riskless position. That is the heart of option valuation. We say that the price of the underlying stock can move like that by that process which is called the log normal diffusion. A diffusion is one that can move all the time, a little jiggle, but not very far. And the second one says that hedged position should earn the same rate of return as a riskless interest rate. What Black and Scholes then were able to say is, okay, what has the option value got to be so that that happens, that a riskless hedged position with the option in the stock earns a riskless interest rate. Right. That's the Black-Scholes equation. That's the heart of option pricing, and it tells you where the risk is going to be when you can't do that hedge the way you'd like to. In other words, if the stock can jump a lot, the second monkey can't keep up, and so that there's going to be risk in the hedge position. All right. So here's the formula back again. And we want to know, we can see what the price of the option is in the market, and we can see the other things that go into the value formula. The one thing we don't know is the volatility, but we can say, okay, what volatility would make the model give us the price we see in the market? That's the implied volatility. Now, that implied volatility is going to depend upon the pricing model you use. The Black-Scholes model is the one everybody uses for this, but there's a lot more complicated models out there where volatility is a little different. The problem with using this volatility is the volatility smile. When we first, back in the 1970s, we think, oh, we got this wonderful formula. We can go down, we can price options. Yeah, well, but I showed you prices for 5 different call options on Apple and 3 different put options, and each one of those would give us an implied volatility. But when I plot, there's only one volatility for Apple. Apple is one stock and it has one volatility. We have a lot of different options that give us a different look at that volatility, and the funny thing is, they all give us different answers. All right? So this is a picture of what the typical plot of implied volatilities for options on the whole S&P 500 stock index would look like. Here's where the index is right now. So taking this back to the Apple example, this is like 210, and this is the implied volatility for the option that has a strike at 210. This would be one that has a strike at 215, 220, and so forth. Ones that had strikes at lower prices have higher implied volatilities. So this is a big problem, right? We can pull out what we would think of as the market's estimate of volatility. We can pull that out from option prices in the market, but it doesn't look like it makes any sense. Right, so that's a big problem. Come now. Now, what I just showed you didn't look much like a smile, did it? That was sort of a real asymmetrical thing. It used to look more like a smile. It looks more like a smile like these ones for individual stocks, and it looked more like these ones before the crash of 1987. What you're looking at here are, my zapper doesn't go that far. Even I can't see what that is over there. This bottom one is the Standard & Poor's 500 index. At the previous picture, we only saw this left side of it, right? This is where the current level of the index is. This red one, this is for the Hang Seng index, and this one is for from options on iShares, a capital large cap exchange traded fund. This is a fund that's supposed to try and match the behavior of the China large cap index using stocks that are traded outside of the China. But you see, it has this pattern. This pattern is everywhere. We see this all the time for stocks. All right? Now, all that's this is for a single maturity, October. Well, we have options with November, December, January, and so forth. If we make one of these smile pictures for each month and then glue them all together, we end up with a volatility surface that looks like this. This, obviously, we're not talking about there is only one volatility for Apple, and all the options are going to use that volatility number. Well, the Black-Scholes model assumes volatility is a constant. And you know it. In practice, you can see that we don't know it. It moves around, and it has to be forecasted. You can calculate what the volatility was over the past, and I showed you that plot. But what we really need to know is what it's going to be in the future. In the 1970s, when we first started with the Black-Scholes model, we thought that the market is efficient. Now, this is an expression that if you take any finance ever, you're going to hear this. The market is efficient, which means what? It means that the stock market is full of smart people who are all trying to make money. They're all trying to use the best information they can come up with, and the price that comes out of their trading has a lot of information in it. It's going to have information in it that no financial econometrician is going to have access to. You know, we know a lot of stuff, but there's going to be a lot of things that we also don't know. All right? So, if we can get the market's volatility forecast, well, that's a wonderful forecast. That's maybe the best we can do. That's what we used to think. All right? Turns out that was wrong. All right? And there's three major problems. One was that we ended up with this volatility smile that I just showed you. This is inconsistent with the model being right. All right? Also, if we agree that volatility moves over time and we can't predict it perfectly, well, people don't like volatility, and they really don't like not being able to predict the volatility. So, like many other kinds of things, they might want insurance. Right? I hate volatility, so I would be made better off with a kind of a contract that gives me a big positive payoff if the market is really volatile. That's an option. So people would buy options not just because what they think the stock is going to do, but they would buy options because they hate volatility and they don't know what it's going to be. If they think volatility is going to be 20%, they might price options, might buy options as if volatility was going to be 23%, a higher price. I'll pay extra for those options just because they will protect me from bad volatility. So that's a volatility risk premium. We might expect to see that there's going to be volatility in we might expect to see that people don't put their best forecast of volatility in. They put in a forecast that involves a little bit of a risk premium. All right. And then the third big problem is that prices don't just follow this kind of log normal diffusion. It can happen. In this diffusion, you can see the monkey can't make the price go up more than $1 per flip, or a penny per flip. All right. But real world prices can jump a lot without allowing you to trade, without allowing the monkey that's hedging to be able to keep up. All right? And all of that says there is more downside risk in the real world than the Black-Scholes model allows for. And so contracts, options that pay off when the market goes down, those are going to be especially desired. And we see that their prices will be higher than the model says they should be. We will see that this volatility smile is downward sloping. All right, so here's a picture. The blue is the prices that we saw already, and the orange is the implied volatility from options on that index. And again, you look at the volatility on the right side, we can see that there are periods of high volatility, periods of low volatility. It's a lot of volatility. Prices spiking up really high sometimes. Right? Now, this is the historical volatility, the 30 days volatility that was actually realized. And the thing I want you to see here, two things. One is that, well, these things move kind of roughly together, but that the implied volatility is generally higher than the actual volatility that's happening. Right? That's the volatility risk premium. Now I said I was going to look at this time period a little bit more closely. Check it out. This was the month of December of 2018. And that's what stocks did. And look at this. For a period from like the beginning of December, the index is close to 2,800. Christmas Eve, it collapses down to about 2,350. This is a huge drop over a very short period of time. What happened to implied volatilities while this was going on? When that huge drop happens, implied volatility spikes up from somewhere under 20 to somewhere about 35. And I think about how big a change that is. Right? This is like doubling in a period of a few days. Right? Important to understand that this is the kind of thing that volatility can do because the implied volatility can do, because implied volatility is a forecast. Right? And it's not only in forecast, but it also involves a risk premium. And if people don't want to bear risk anymore, they start getting scared, they're not going to be ready to sell options except if you give them really high prices. And that's what that implied volatility means. All right. So this is kind of a summary of what we've seen. Here's some common findings of research on volatility that confirm that what we've just seen is basically true in general. It's not just in a couple of examples. Volatility isn't constant. It changes a lot over time. We saw periods of high volatility and periods of low volatility. So that kind of means that it's not like it could be really high today and really low tomorrow and then really high the day after that. It tends to go through periods of where things are volatile and then periods where things are pretty calm. There appears to be mean reversion. Now, this is different from what stocks do. You know, and as the stock market goes up, there's nothing to say it can't keep going up. But when implied volatility gets really high, it's probably going to come back down again. When it gets really low, it's probably going to come back up again. It doesn't drift off to infinity. It doesn't drift off down to zero. It kind of stays around in this general area. Stock market volatility. This is for the stock market in particular. If the market goes down, volatility goes up. If the market goes up, volatility tends to go down. The effect isn't quite so strong. There's a regular structure of implied volatilities across options on the same stock with different strike prices, the volatility smile. And if we look at options with different maturities, we see that there's also what you call a term structure, which is that implied volatilities for different maturities will be different. Okay, well, so that's an introduction to what volatility is for an options kind of a person. It's a little bit more on this than I thought I was going to do, but I hope that you've gotten some understanding of what it is that we're talking about. Now, the implied volatility, that orange curve that I just showed you, that's the implied volatility on from options on the Standard & Poor's 500 stock market index, right? This is the index we are all looking at. The Chicago Board Options Exchange, the biggest options exchange in the world, they wanted to have an index like the Standard & Poor's index for stocks, but this one would say, well, how are options being priced relative to stocks? In other words, the implied volatility is a measure of how the options are priced relative to the underlying stock. And so the VIX index is an index of implied volatilities. It's supposed to be a 30-day contract. So the options have specific expiration dates. The third Friday of the month of October, for example, October 18th. The next one is going to be the third Friday of November. Well, to get 30 days, we need to kind of have a blend of the two. So it's interpolated between contracts with shorter maturities and contracts with longer maturities. The original VIX formula just focused on options that were at the money, around the numbers that I had you thinking about before. For Apple, at the money is where you buy at the same price as the current level of the index. But so what that means is that the VIX originally wasn't affected by this volatility smile. They changed the formula in 2003. It uses all options where the price you trade at is less good than the one in the market. In other words, for a call option, the price you would trade at is higher than today's price in the market. For a put option, the price you would sell at is lower than the price in today's market. These are the ones that are most affected by volatility. And so a calculation involves all of them together. Is the way that they do the VIX now. All along, I've been talking about this as a measure of volatility that's forecasted into the future. But as we've had experience with this thing, as we've seen it going up and down over time, then we see that Well, people have come to call it the market's fear gauge. If the market is scared, the VIX goes up. The market is feeling calm and mellow, the VIX goes down. The VIX market fear gauge. And the point is that to emphasize in that is that we're not just talking about predicting what the volatility is going to be. We're also talking about how much people would be willing to pay to insure against bad volatility. Well, the CBOE started trading. They liked the index. Everybody liked the index. And so they started trading futures contracts on the index. And they started in 2004 and options on the index in 2006. These markets became incredibly popular. And they started inventing new kinds of contracts that would all be tied to this volatility index, the VIX index. So there are literally hundreds of futures and options and exchange-traded funds. This is like a mutual fund that you can buy or sell on the stock market. ETFs and notes, all based on the VIX and on other VIX type of indexes. So longer maturities, different underlying stock indexes, and so forth. There's hundreds of these things. Well, to be clear, an exchange-traded fund, it's like a portfolio of stocks, a mutual fund, where it's tied to a particular thing. And the most popular one is the Standard & Poor's Depository Receipts, SPDR, affectionately known as SPDRs. And you want to buy the standard, you want to buy a cross-section of the whole stock market. You want to buy the S&P 500 index. Well, yeah, but I'm not in a position to buy 500 stocks. But I can buy one share of this thing, and this portfolio holds the 500 stocks, and then I can just buy a small piece of that. And it's like I have invested in the Standard & Poor's 500 index portfolio in this way. And now there's options trading on this thing too. So the same kind of idea of having an exchange-traded fund that is based on the VIX. Well, people like that idea, and there's hundreds of these things. Not only do they have ones where you can buy something that looks like you're buying a piece of the Standard & Poor's 500, there's some that are set up so they're supposed to do twice what the S&P 500 does, 3 times. So if the index goes up 1%, the double one should go up 2%. The triple one should go up 3%. The index goes down 1%, then you're going to lose 2% on the double and 3% on the triple. There are ones that have negative exposure. So if the market goes up, this thing goes down. If the market goes down, this thing goes up, like a short sale. And there are ones that have both negative exposure and leverage. It's really nutty, some of these things. Not one of these products, though, is able to track the actual VIX index. The VIX index is, I'm going to take the options that are traded today, I'm going to essentially calculate their implied volatilities and make an index. In theory, that index should be the market's estimate of how volatile the stock is going to be until those options mature, plus a risk premium. And the risk premium can go up or down over time. The forecast of future volatility goes up and down over time. And you can't buy the VIX. You can buy the stocks, but you can't buy the VIX. The VIX is more like, whoops. Well, I've almost skipped ahead, but let me quick. What I was about to say is the VIX is more like a temperature. You can see what the temperature is, but you can't look at the temperature today on Tuesday and say, I like this. I'm going to hold this until Saturday so I can have a nice afternoon. You can't buy and hold the temperature, and you can't buy and hold the VIX. Right? So what this slide is basically saying is that the way you can't buy the VIX, you can't buy or sell the VIX, so they try to create something that behaves like the VIX using futures contracts or options or other kinds of more exotic derivatives like volatility swaps in order to create something which is going to, they hope is going to behave like the way the VIX behaves. Right? Here are some of the exchange-traded notes. And just the only reason I'm showing you this is two. One is to say, well, you've got ones that have negative exposure, you've got ones that have positive exposure, have double exposure. This one in particular, the XIV, you might notice that it's the reverse of the VIX. VIX is VIX, this is XIV, this is a negative, an inverse one. All right? Keep this one in mind. Here's some more. All right? Just to show you there's a lot of these things out there. All right, okay, so now here's the point that I wanted to make. The VIX is more like a temperature. You can observe the current level, but you can't buy nice weather today and hold it for the weekend. And by the same token, you can't buy today's VIX, carry it over time, and deliver it against a future option contract that matures in 30 days. So a futures contract says, we're going to make a contract that pays off based on what the VIX is 30 days from now. What the VIX is 30 days from now has nothing to do with where the VIX is right now. In the same way as the temperature in 30 days, so the temperature is 2 degrees higher today than we thought. What does that tell us about what's going to happen in 30 days? Nothing. So this has really important consequences. I told you about how the option pricing model is based on this arbitrage trade between you buy the option and sell the right amount of stock to make it riskless. And that's how we get the model for how the option should be priced. There's a similar kind of model that's actually much easier to tell you how a futures contract should be priced. But there is no such model possible to tell you how a VIX derivative, a VIX future, a VIX option, a VIX exchange-traded fund ought to be priced because it's being created with things that are not perfectly aligned with the actual VIX. So the second consequence is we don't know how to price the VIX, and strategies that involve combining the VIX with something else generally don't work either because there's no direct connection between the VIX that we see in the market and the exchange-traded funds, the futures, the options that are all tied to the VIX. And just to give you an idea here, maybe I should use this. This is, how does the VIX futures, how connected is it to the actual VIX? Right? The VIX is what we see from options right now. The future is, what is this going to tell us about the VIX when the futures mature? Well, if the future is maturing tomorrow, one day, the correlation is only 0.8. If the VIX is maturing in a week, the future is maturing in a week, the correlation is about 0.5. If we're looking at a 1-month contract, the correlation is less than a half. All right? So anything that's that is based on the VIX moves in a certain way relative to the underlying stocks, you can't replicate that with any kind of a trade. Here's another thing. This is the term structure on the VIX. Now we're looking at, imagine, I don't actually know when this date comes from, but let's say that this was, the VIX in the market right now in August is 15.3, 1537. The future for the VIX 30 days from now is 16. for 2 months from now, 17.5. Now the question is, what's going to happen? Are these things going to change? Is this 17.5, is this that the market thinks that 15, this number, that's where the VIX really ought to be, and this is actually people buying insurance. So as time goes along, we would expect this number to drift down towards 16 and eventually getting down there. So if I sold this, then it's going to eventually go down and I make money. Right? On the other hand, if this is really like a temperature, this is just a prediction, the market's prediction of where the thing is going to be 2 months from now. And there's no reason to think that our prediction is going to be any different tomorrow than it was today. If we thought tomorrow's prediction was going to be different from today's prediction, we're making the wrong prediction today. Well, a lot of these trades are involved with thinking about, well, how is these future contracts based on the VIX, how are they going to move? And the answer is we don't really know. Probably it's something in between what I said. Is we're going to go down a little bit, maybe, expect to go down a little bit, but not all the way down to 15. Right. So, if you look at this time period, for example, the VIX is high. And it's high, 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 and it never goes down to what's actually happening. So let me tell you the sad story. We're almost at the end here. Let me tell you the sad story of the XIV that I told you about. Right. This was an exchange-traded note that was issued by Credit Suisse. And it had an inverse exposure to the VIX index. And during the time periods that we were just looking at, the VIX is going down, 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 down. And here, again, going down. And so people were finding that it sort of seemed like all you had to do was to take a contract that would make money if the VIX went down and you were guaranteed profit. And the actual profits on those contracts were enormous. People got really excited about this. And you got to know that when you go and look on the web and Yahoo Finance, and there's a big story about this kid, 18-year-old kid trading in his basement, high school student, made $2.5 million with this VIX trading strategy and so forth and so forth. You got to know that there's something wrong with that strategy. And so people kept selling. It didn't matter that the VIX was that the VIX in the market was at 11, and historically, on average, for the last 25 years, it's been over 20. Still, they thought it was going to go down even further, and it did for a while go down even further in a surprising way. But the key thing about the VIX is that it's all expectations, and people can change their minds instantly. So on February 5th, 2018, the S&P index fell by 4%. This was a huge drop. Right? Everybody got really worried at that point. It was only one day, right? And on that day, the VIX jumped from 17 to 37.5. And the people that had this contract that loses money if the VIX goes up and makes money if it goes down, they suddenly lost a lot of money. Right? Worse yet, this contract had a special provision that said that if the underlying portfolio of things that they were using to try to make this negative payoff on the VIX, if that portfolio of things dropped to 20% of its original value, they're going to close the whole thing down. They're just going to liquidate it. And that happened. So they're now supposed to liquidate it after the market has closed. They're still trading, but the stock market is closed, and so they ended up liquidating these things at a level of the VIX in the neighborhood of 45%. These folks recovered less than $5 on a $100 initial investment on this thing. Right? And why? Because they were betting that the VIX couldn't jump the way it did. And they also got really hurt by this provision that required the whole thing to be unwound after trading in a regular market. All right. Okay, I'm going to skip the rest of this. Oh, but I did want to show you something. We had this issue of here. Suppose I buy. I have a position, a long position in the VIX, right? So I'm going to buy if it goes up, and that's my strategy. That's what the exchange-traded funds say. We're going to create the same payoff as owning the VIX. All right? Well, if the VIX has a tendency to fall over time because it has a risk premium in it, this portfolio, this VIX-based exchange-traded fund starts off and loses until we get to the wild market crisis in the fall of 2008. Suddenly it gained some value, but the whole idea of owning this thing over time, you can see this wasn't a very good investment. So what I end up with is the market is all excited about these things. They're being created left and right. I can't quite figure out what they're really useful for. But one thing, well, that's not actually true. As an investor, I can't figure out what these things are useful for. As a research professor, I know exactly what these things are good for, and I plan to do this because how all of these things fit together. We have the Standard & Poor's Index, we have futures on the index, we have options on the index, we have exchange-traded funds, and we have futures and options on the exchange-traded funds. And then that's not just on the level of the S&P index, but also we have a similar array of instruments all on the volatility of that index. All of that stuff has to fit together somehow. I think that's a wonderful research topic. That's what I plan to be doing in some of my research going forward. And I would encourage all 416 of you out there to get interested in this stuff too, or at least to have some familiarity for it. So bottom line on this thing, I've enjoyed this talk. I hope you've gotten something out of it. And once again, I'm very grateful to United College for providing me the opportunity to give this talk. And if you like this one, come back tomorrow. I'm going to talk about extracting information from option prices. Thank you.
So thank you, Professor. And I'm sure that there will be some questions on the floor. So I would like to invite our moderator of today's lecture, Professor Chow, to come up and host the Q&A session.
So great. So let's thanks Professor Stephen Figlewski for wonderful sharing about his insights on the new frontier of derivatives markets. Any questions? Actually, I want to ask, how many of you have taken my class? Any of you taken my class, Finance 3080 Investments? I should have taught you Black-Scholes model. Okay, so questions?
So hi, Professor Figlewski. Nice to meet you. I'm David from the history department. Although I study history, but I'm also interested in the finance world as well. And I have two questions basically. One is that last month, J.P. Morgan has included 10 Chinese government bonds into its GBIEM index.
I'm not hearing clearly what you're saying.
Sorry.
My ears are not very good. I'm not hearing
like last month, J.P. Morgan has included 10 Chinese government bonds into its GBIEM index. So it kind of So what is my interpretation is that the Chinese market is obviously growing bigger and have more influence on the global finance market. So I would like to ask, how would you view the Chinese market or Chinese investors is going to affect the global investment environment in that respect? And my second question is that there are a lot of signs of uncertainties in our time, like the trade war, and like for the past few months there was inverted yield curve and all kinds of uncertainties as well. So a lot of investors, they are predicting that recession is going to happen very soon. But from one of your work in 2009, you said that the stock market or the whole investment game is basically a zero-sum game. But with all the resources and information asymmetry between the normal people like us and the professional traders, how can we profit or survive from this kind of uncertain market?
Okay.
Thank you very much.
Well, there was an awful lot in those questions. Let me kind of start from the end and move backwards towards the beginning. One thing that we always tell our students is that you shouldn't try to speculate in the market. That I disagree with one statement you made. I do not believe that the stock market is a zero-sum game, but options and futures and those kind of contracts are a zero-sum game, because if I make $1 trading an option, that's the dollar that the other side of the option is lost to me, and those contracts just transfer money back and forth. But we can all buy stock, and when the stock market goes up, we all get richer. Right? So there's a big difference between buying stocks or bonds and the kind of derivative contracts that I've been talking about. So what we've always told our students, and strangely enough, as a professor, I actually believed what I taught, which is that you're much better off to buy a cross-section, a portfolio of stocks that looks like the whole stock market, and don't try to fiddle around and trade and predict when it's going up or down or so forth. That over time, the stock market has done, in the United States, has done absolutely brilliantly, and in most countries it does, over time, it does well. But you have to also ignore a lot of the kind of things that people are worrying about. You just have to say, I'm in this for the long haul. It's only when you get to a point where maybe you're going to need the money very soon, and then it's perhaps better not to have so much in the stock market. But the idea of, I should buy stocks because they're going up, I should sell stocks because they're going down. Mostly when people make those kinds of trading decisions, they end up doing the wrong thing. Lots of people in 2008 got all scared because the stock market looked terrible. The whole economy looked terrible. The world economy looked terrible. The stock market really did go down, and then if you hadn't paid attention to that, it's tripled since then. I'm not sure if it's tripled, but it's gone way up since that. So that's kind of what we as finance professors would suggest. And I'll tell you that, having done it myself, when I've deviated from that, I generally end up thinking, that was a dumb thing to do if I just kind of ignored it and let it go. So that's one thing. The second question first question actually in reverse order, had to do with what's going to happen as the Chinese financial system gets more integrated with the world. Obviously, the Chinese system, the Chinese economy is huge, and I think Chinese investors would be very eager to be able to invest in outside of China, and I think they're quite limited in being able to do that. If the Chinese government were to decide tomorrow, okay, fine, you invest anywhere you want to, I would imagine that there will be a lot of diversification of Chinese investors out of China and into the rest of the world, and American and European and other investors investing into China, the markets will become more integrated, and I can't really speculate on whether volatility would go up or down. I'm not sure about that. But I think that in general it makes everybody better off to have more options for diversification. So. Do you want to call on?
I'm a student of finance. I'm a student of finance, so I'd like to pose to you, Stephen, 2 questions. The first question is on the read an editorial that was done by you I think 2 years ago in 2018 on the devising a derivative overlay on the portfolio. That writer is saying that you should do a right call and right put as a matter of rebalancing. So that instead of doing the rebalancing yourself, you just use the option to do the rebalancing, which is an automatic rebalancing because you simply to write the calls, and once the stock price has reached that level, that stock will be called away from the portfolio, and then when the stock drops to a certain level, automatically that stock will be injected into your portfolio in such a way that is a simple way of doing rebalancing. Do you believe that this type of rebalancing, this is some sort of automatic rebalancing, will actually enhance return over the long period of time? This is the first question. The second question I want to pose to you is on the fact that every day the Hong Kong Stock Exchange will have a option pricing. Many of the out-of-money stock options actually are not traded during the day, say 5,000 pounds out of money in a month. But then they still have a price, basically, presumably, based on the Black-Scholes model. But then in actual trading, and then you actually trade on it when you ask for a stock market quote, you ask for the market maker to give you a price. Actually, invariably, the price is much higher than what is set by the stock exchange quote in the previous day, despite there's not much volatility. My guess is there is something, basically, as you said, the Black-Scholes model does not catch that well the very long out money the option structure. Is there any other model which basically will capture the two extreme spectrum of the option structure?
Well, those are fairly detailed questions. My take on the second question, if I understood the issue that you're raising, is that when the exchange quotes a price on an option that's not being traded, if you then trade that option, the price you actually get would be maybe quite a lot different from what the exchange said, much higher even. Yeah, well, I can't really say, because I don't know exactly how the exchange will set those settlement prices. I can't say why this is happening. It's very normal, though. You should understand that even in contracts, even in an options market where the underlying asset is very liquid, like Apple stock or like the S&P 500 index, there will be options that have long maturities. There will be options that are very deep in the money, meaning the price is way more favorable than the current market price. Well, those contracts have hardly any optionness to them anymore. You know, if you have a contract that says you can buy Apple for $150 a share, there's no option there. You know you're going to do it. All right? So nobody wants to trade those ones. An option that says you can buy Apple for $500 a share, it's not going to get that high, and so nobody trades those either. But if the exchange has listed them for trading, they have to provide prices. So how do they make those prices? How do they make the price for an option that nobody is trading? And the answer is, I don't know. right? But apparently the price that they pick isn't such an accurate one. Now, in markets where there are designated market makers, these are people whose business it is to stand there and be ready to trade with you. You want to buy an option? They'll sell it to you. You want to sell an option? They'll buy it from you, and they will quote a price at which they'll buy, a low price, and a price at which they'll sell, which is a higher price. All right? In our markets, those prices are firm prices. So you can actually trade at those prices. You can't trade 10,000 contracts, but you could trade 100 contracts at those prices. And so those are real prices, but they might be quite wide. All right? It could be that the bid price is $1 and the ask price is $1.50. Well, there's a lot of range in between there. All right? So an artificial price that's set by the exchange but doesn't require somebody to be ready to trade at that price, I don't know, that could be artificial. Right? Coming to the first question, this is an interesting point, which one of the features of options, if you remember the monkeys, right? As the monkey who is trying to hedge the options, as the price of the underlying stock changes, the fraction of options, fractions of stock that would hedge the options will also change. And a way to think about this maybe is that an at-the-money option is, for small changes in the stock price, behaves like about half a share of stock. Right? If the stock price goes up, now the option begins to trade more and more like a whole share of stock. If the stock price goes down, that same option trades like almost nothing at all. It becomes nearly worthless. Right? So people may want to run a portfolio strategy where they say, if the stock market goes up, I want to be in stocks. If the stock market goes down, I don't want to be in stocks. That's a strategy that people devised in the 1980s, and they called it portfolio insurance. And what it amounted to was trading between the stock and cash in such a way that the combination behaved just like a portfolio that had a put option on it. In other words, a protected portfolio. And the way that strategy works is, when the stock market is going up, you're rebalancing to get more and more and more into stocks. When the stock market is going down, you're rebalancing to get less and less and less in stocks, more and more out of stocks. Right? If you buy an option, that change is pretty much automatic. The portfolio insurance strategy that was done in the 1980s was, we don't buy the options, we're going to trade the stocks so that our combined position looks like the option. And what we discovered is that doesn't work. We discovered in the crash of 1987 that can be disastrously wrong. There's a big difference between having an actual option that does this kind of changing its exposure automatically when the stock price moves, and portfolio insurance, where we're trying to buy and sell stocks all the time to create that options exposure. And that turns out to be risky. So if I got the main point of your first question, it was, do you think the options are a good way to implement this type of a strategy? And I would say, yeah, I think that an option is a good way to do that type of a strategy. But that's an actual option, not creating an option payoff just trading the stock and cash.
Okay, great. Given the time limits, we have a last question.
Hello. Hello, Professor. I have a question about the VIX you mentioned. Because you say that there are some financial products, for example, the funds or the derivatives related to the VIX. So will there be for example, there are some investors investing in the VIX related products. They may have some incentives to increase more volatilities because they want their VIX, the index, to be more. To be more valuable, and they will introduce more noise in our market. And so as a result, there may be more information asymmetry and the information problems in the financial market. So how do you think about this potential problem?
That's a very good question, and that's the kind of question that people have been asking always about derivatives, about futures, about options, and these markets are very speculative. If we allow people to speculate in these markets, doesn't that disrupt the whole world? Doesn't that disrupt the price of the underlying stocks? And it's easy to spin stories about, well, if this were to happen, if that were to happen, and so forth. But there's an underlying feature of all of these derivatives that I feel makes a whole lot of difference to their interaction with the rest of the market. We have these derivative contracts, but every derivative contract has one side and the other side, and they are symmetrical. So if I buy a futures contract on the VIX, there's somebody, and then I make money if the VIX goes up, and I'll be really happy if the VIX goes up. I'll be unhappy if the VIX goes down. But on the other side of the contract that I just bought is somebody who's got exactly the opposite exposure. So I may be wanting the VIX to go up, but the person on the other side is wanting the VIX to go down. And there's a real question in my mind whether having these two counterparties to this contract dealing with each other, where their interest, what they want to have happen, is opposite and symmetrical, that I don't really see how any of these things should have anything to do with how the underlying market behaves. And an example I like to use is when the crash of 1987 happened, the whole stock market went down by 20%. So all stocks fell by like 20%. Right? Well, that means that if you think about, well, what was the total amount of wealth that was in the stock market? Well, it was a fifth lower by the end of that day. Everybody lost a lot of money. But on top of that, here are all these futures contracts and options that are also tied to the stock market. How much more how much more loss was caused by those? And the answer is zero. They are a zero-sum game. So if one guy lost $1 on the futures contract, somebody on the other side made that dollar back. So the profits and losses that are happening in any of these derivatives, futures, options, more exotic kinds of things, I feel are just kind of an overlay of froth that's going on top of the stock market and should not have much of an effect. That's, based on this, the underlying fact that these are all zero-sum contracts, and so we got people on both sides. It's not like everybody suddenly decided to go, we're all going to sell our stock. If we all decide to sell our stock, the stock price will go down. Well, if we all decide to sell futures, people who had a long position of futures are going to lose money. The people who had short positions are going to make money. And the sum of the two profits and losses is going to be zero. So that's my...
Okay, thanks. You have the privilege.
All the good question people are in the front rows.
The whole Black-Scholes model is predicated on the perfect market assumption, which may not hold true in effect. do you think in your analysis of research, do you think that this type of imperfection in the markets, like the continuous trading, frictionless markets, zero transaction costs, everyone can invest in risk-free rate, based on the no arbitrage and reason neutral probability models, actually hold true in practice?
No, I think that certain kinds of things should hold true in practice, but other sorts of things that the differences between theory and practice are big enough that you get completely different behavior. One of my favorite quotes, and I can't tell you who gave this, it's that, well, in theory, there's not much difference between theory and practice. But in practice, there is. And in practice, like here's an example. In the very early days of stock index futures trading, we have a very clear, we may disagree about option pricing, but futures pricing is very straightforward. And in the very early days when stock index futures were first introduced, they were priced too low. And most of the time, not always, but a lot of the time they were priced too low. And people said, how can this happen? And so, academic theorist type people are very clever and can think of all kinds of things. And so before long, they were publishing articles about how, well, there was a slight difference in taxation if you held a position for more than 6 months. And none of it made any sense at all. The big reason was the trade that you do in theory is if the future is priced too high, you buy the stocks and you sell the future, and you lock in a return that, if the things are mispriced, that you lock in a riskless return that's higher than you can make in a bank. If the futures price is too low, you have to buy the future that's priced too low, and you have to sell short all those 500 stocks. And then you take the money you got from selling short the 500 stocks and you put it in the bank and you earn interest. Well, you couldn't do it. You couldn't do that trade. You couldn't sell those 500 stocks at one time. In those days when it was first introduced, you couldn't send orders into the market electronically. They had to be carried on paper. So when somebody has to go do an arbitrage that says, buy 500 stocks, they had a whole shoebox full of order tickets that they would hand out, and people would run around to the various trading posts and delivering these things. There were not very many firms that could do that type of a trade, and they certainly couldn't do the type of a trade where they had to sell short all of the stocks, take the money, and then invest in something else. So in the early days, there was a theoretical trade that should have kept the futures price high, but you couldn't really do the trade in practice, and so the price tended to be too low on average. As the market got more established, as he started introducing electronic order transmission, as firms got comfortable with the idea of being able to trade all these stocks all at once, then the deviations, the mispricings got much, much smaller in the market. Right? So, excuse me, the point being that we may assume away transactions costs and so forth in theories, but in practice they matter, and sometimes they matter a lot. These days, the transactions costs in doing the arbitrage in futures, we've learned how to do this, and you don't see very big arbitrage opportunities in the futures market. We used to see them much bigger before you could do the trade. And so mechanically, what you can do in the market really is important sometimes.
Great. Let's conclude. If you have more questions, please come back tomorrow. Thanks again for Professor Figlewski.
Thank you, professors. So to express our appreciation of our college, we have prepared souvenirs for both the speaker and the moderator. So may I now invite Professor Jimmy Yu, the college head, to present a souvenir. First, to our distinguished visiting scholar, Professor Figlewski, to receive the souvenir. Thank you. Then we'll also like to present a souvenir to Professor Jay Chow.